He is Jeff Papp, senior analyst with the Oberweis Asset Management Fund, helping invest $700 million in China. So, Jeff, first of all, thanks for joining us today. And I've got to ask you right off the bat, it seems so counterintuitive. GDP in China growing 9%, and yet the Chinese stock market down 23%. What's going on?
Yeah, 2011 was clearly a year where fear dominated. Fear was on investors' mind as they worried about how all the liquidity that was pumped into this system in 2009 to start off the 2008 financial crisis would impact inflation. And clearly in the first half of this year, we saw inflation get up to a little bit higher than wanted levels of 6.5% in July. And this prompted the Chinese government to restrict liquidity, increase interest rates, and increase bank reserve ratios multiple times. This then led investors to fret about what would that do to Chinese growth, and led them to believe that Chinese growth was going to fall off a cliff. Now, this is in stark contrast to what happened actually with earnings growth. Earnings for the MSCI China index was up around 20 to 30% for the year, yet stocks declined 20 to 40%. So usually we would expect over time that stock prices would follow earnings, and yet this clearly wasn't the case this year as fear dominated.
All right, let's talk about what's happened to the Chinese market. You obviously have money at risk. You have lost money this year in China, and now stocks are certainly very cheap. The PE for China, if you just look at the index, at about 10.5 times versus, say, 12.5 times for the U.S. What's your outlook for the valuations of Chinese stocks as you look into 2012?
Yeah, we think they're really, really cheap. I mean, the one thing entering this year that we didn't have at the beginning of last year was the government on our side. As we entered the beginning of last year, the government's stance was to control inflation. As we enter this year, the government's stance is to ensure that growth continues at a reasonable clip. So we may not see 10% growth, but we're probably going to see 8% growth. And what this means for stock prices is that currently many investors are very skeptical of China's growth continuing into next year, and this has been implied in the stock prices, where earnings growth is probably less than 10%. So we think as long as we don't have a hard landing scenario, that stock prices can work for Chinese equities in 2012.
Hey, Jim Chanos, who runs one of the best-known short-selling funds here in the U.S., has been extremely bearish on China. He's concerned about the overbuilding. What's your take on that?
Yeah, well, I think his main argument is the overbuild and how it relates to property prices and a collapse in property prices leading to a crash landing of the economy similar to what we had here in the States in 2008. And the one thing that we would counter with is there's clearly a lack of leverage in the system, especially on the consumer side and on the individual side as it relates to home mortgages. You got to remember, most Chinese buy their homes with all cash or take out very little in terms of mortgages. And with that lack of leverage in the system, we don't see a huge collapse bringing down a domino effect like we saw here. Now, clearly we think that property prices have gone up a tremendous amount and could be too high. But again, we think that a lot of this has been mitigated by the fact that Chinese developers, the ones that are listed, trade at discounts to their net asset value of some 50 to 80%. So a lot of this potential bust in terms of asset prices has already been accounted for in stock prices today.
Which perhaps is why you see China trading at 10.5 times, historically cheap, certainly discount to the U.S. Let me ask you another question, and it has to do with the legitimacy of the accounting practices in China. That was, of course, brought to light in the whole Muddy Waters Sino-Forest incident. How confident are you in accounting procedures, the legal system, et cetera, in China?
Yeah, that's a struggle, and that's why we think the best way to approach investing in China and to capture some of the growth is to go with a firm that has people on the ground like we do with a team in China who understand relationships, who understand how the accounting works, who can get in there and really kick the tires with the individual companies to see what's going on. Now, there have been a lot of scenarios with Muddy Waters finding Sino-Forest to be a fraud and some of the accounting not holding up. But again, we think this is a few bad apples in the whole bunch, and we think stock prices today more than compensate for what could be some accounting irregularities.
Hey, let me in the last 30 seconds here, if I can, Jeff, just get your top pick for China, 2012.
Yeah, we like a company called 21Vianet. It's actually listed on the NASDAQ under VNET, and they're a leading provider of data centers in China. What we've seen is internet services in China explode. E-commerce is growing 100%. Online video is growing 100%. And what that means is that big internet companies like Taobao are going to need more servers, and VNet does the hosting of the servers without the fierce competition. The company's growing 50% next year, has $200 million in cash and trades for about 6 times next year's EBITDA when you exclude that cash. So we think that's, again, a very great place to find growth at very cheap valuations.
All right, Jeff Papp of Oberweis Asset Management, we appreciate your perspective on China. Have a great new year. Thanks, Jeff.